Imagine you are walking down the street and see a local pizza shop with a for sale sign. You wouldn't buy it simply because a friend told you it was a good idea. You would look under the hood to see how much profit it makes, how much debt it carries, and how efficiently it operates. Buying a stock on a digital exchange requires the exact same approach. A common trap new investors fall into is treating financial ratios like a high school math test. They memorize isolated formulas for a few days, pass an arbitrary test, and completely fail to understand how those numbers connect to the daily operations of a business. To fix this, we are going to evaluate a fictional business, let's call it Alpha Corp, using a unified health report card. We will analyze it across 4 connected pillars: profitability, valuation, efficiency, and shareholder return. By linking these pillars together, we build a continuous chain of logic. We stop looking at random numbers in a vacuum and start building a reliable diagnostic tool that works for any publicly traded company. We start with profitability, and the absolute baseline metric is earnings per share, or EPS. If this entire pizza represents the total net profit of Alpha Corp, the stick figures standing around it are the outstanding shares. EPS tells us the exact size of the profit slice that belongs to one single share. Notice what happens to the math. If Alpha Corp buys back its own stock and reduces the total number of shares, the same amount of total profit is divided among fewer people. Each remaining slice gets larger, driving the EPS higher. A growing EPS points to expanding earnings and better business performance. But knowing how much profit a share makes does not help us unless we also know how much it costs to buy that slice in the first place. Profitability alone cannot tell you if the stock is cheap or expensive. This leads us to valuation. Let's say Alpha Corp has an EPS of $10, but the market price for one share is $500. To figure out if this makes sense, we calculate the price to earnings, or PE ratio. We take the $500 share price and divide it by the $10 EPS, which gives us a PE of 50. This means investors are currently willing to pay $50 out of pocket to acquire just $1 of Alpha Corp's annual earnings. A high PE usually implies an expensive stock, but context is required. A high price tag might actually be justified if the company is growing its profits at an incredibly fast rate. We verify this using the PEG, or price-earnings growth ratio. By dividing the PE ratio by the company's expected earnings growth rate, we adjust the valuation to account for velocity. A PEG ratio under 1 points to a potentially undervalued stock, while a number over 1 signals it might be expensive. Valuation metrics are hollow on their own. You always have to cross-reference the price you are paying with the growth rate you expect to receive. Otherwise, you risk locking your money into expensive, stagnant businesses. Once we know the price is fair, we have to test efficiency. The standard metric here is return on equity, or ROE. This tall bar shows a 20% return, indicating that management is doing an excellent job generating profit using the shareholders' money. But ROE has a blind spot. Because it only looks at equity, management can artificially inflate their return percentage by funding the business with dangerous levels of corporate debt instead of shareholder cash. To expose the actual operational strength, professional investors use return on capital employed, or ROCE, and EV to EBITDA. These metrics force both the debt and the total capital back into the equation. Here, ROCE reveals the true lower efficiency once the debt illusion is stripped away. Looking exclusively at equity hides the risk. A rigorous efficiency analysis requires measuring the entire capital structure of the enterprise to see how well every dollar is being utilized. Our fourth and final pillar is shareholder return. After all the profits are calculated and the efficiency is measured, we need to know how much actual cash is delivered straight into the investor's pocket every year. Let's test this with Alpha Corp's final variables. The current stock price is 500 rupees, and the company pays out an annual dividend of 10 rupees per share. Pause the video right now and calculate the dividend yield. We divide the 10 rupee dividend by the 500 rupee stock price and multiply by 100, giving us a dividend yield of 2%. The dividend yield proves exactly how much cash income you are generating from your ownership. It grounds theoretical profit numbers into hard, realized income. Here is Alpha Corp's completed health report card, populated with our calculations. The data presents a contradiction. A reasonably low PE ratio makes the stock appear cheap, but blinking red indicators on the high PEG ratio and low ROCE warn of poor growth and a heavy debt burden. This means we pass on investing in Alpha Corp. The debt and growth red flags overrule the single positive valuation metric. The business is cheap for a reason. Now it is your turn. Take a screenshot of this ratio matrix. Pick any publicly listed company and build your own one-page investment report. Calculate these metrics, map out the strengths and red flags, and make a final investment conclusion. Analyzing a stock is an exercise in reality. You don't build wealth by passing a memory test on financial math. You do it by cross-referencing specific metrics to expose the underlying operational truth of a company.